Ever wonder what the smartest investors are talking about behind closed doors? Well, today we're going to dive into undervalued stocks being discussed in value investment clubs, and they might just be selling for less than they're worth. While everyone else is chasing the hype, we're digging into real value stocks. Today, we're going to dive into undervalued stocks that are being discussed by investing experts in value investing clubs, and they might just be selling for less than they're worth, which is the true goal for every value investor. Stock number one, Paycom software. Now, guys, I own Paycom software. I got very lucky. One day they absolutely plummeted to below 150. I picked up some shares and it went down to 140. I picked up some more and then it skyrocketed from there. Don't buy a company just because somebody on the internet says it, that they have it. We're here to teach a principle-driven process for investing. If you're looking for someone to just hand you stocks to buy, we're not the ones for you. If you're trying to learn a process so that you can become a better investor, this is the channel for you. Now, Paycom is turning heads in the software subscription business with its relentless focus on employee management solutions, especially payroll. Here's the big headline. Paycom holds the top market share in all payroll applications. In a space that's crowded with tech-savvy competitors, that isn't something to laugh about. It's no small feat. They've earned their crown by prioritizing automation and delivering a customer experience that saves clients time and money, a knockout combo. Now, let's talk about numbers. 98.5% of their Q3 revenue was recurring revenue. Every investor loves to hear that. Recurring revenue is the gold standard. It's stable, it's predictable, and it's scalable. It's like having a financial fortress no matter what the economic climate is. Now, that doesn't mean that if all of a sudden we have a lot of payroll drops, this isn't going to take a hit for Paycom. It will. But their proprietary Betty software is redefining payroll by letting employees handle their own paychecks. Could be a small tweak, maybe, but the ripple effect on efficiency and customer satisfaction is absolutely massive. Add to that Paycom's push into larger markets, chasing bigger clients, and you've got a recipe for strong and sustainable growth. Now, in 2024, there was also a lot of leadership changes. A co-CEO stepped down, and new faces filled critical roles. Some might see this as a red flag, but it looks more like a calculated move to sharpen their focus on automation and getting a high return on the money that they invest in the business. So what's the bottom line? Paycom is an innovation machine wrapped into a financially stable model. For value investors, the question is very simple. Does the stock price leave room for a margin of safety? If so, this could be a powerhouse worth watching. Now, one of the hardest things I deal with as an investor, and you probably deal with, is I bought this company at 150. So I have this attachment to 145. I bought it below 150, 140, 145. But just because a stock is up does not mean it is overpriced. It could still be a great add along the way. I made that huge mistake years ago when I bought Microsoft at $17 to $21 a share, and it just kept growing and growing and growing, but it got a little overvalued, so I sold it around 60. And what's happened since then? Microsoft's worth well over $250 a share probably today. So as it got better and better and better and the stock went higher, I should have been adding to it because its intrinsic value is getting better. Paycom is absolutely incredible. They generate $300 million a year in free cash flow, $220 over the last 5 years. Now, their net income is significantly higher. So you have to figure out, understand why that difference is there. But you look at this and say, okay, it's selling for 38 times free cash flow, which is a lot. And you might sit there and say, well, Paul, when it was below 150, what was it selling for? 25 times free cash flow? That's a lot. It could be. But remember, a fast-growing company with a gross profit margin of 82%, that could justify paying that premium for it. Because if two companies are exactly the same, all the numbers are the same except for growth rate, you'd buy the higher growth rate business. 20% a year versus 5% a year. Which one are you paying more for? You absolutely have to pay more for the 20% growth rate. So let's check out these 8 pillars and see what it looks like here. Like a lot of our companies that we love, check marks all around except for valuation. 5-year PE and 5-year price to free cash flow are very high. Very, very high. But can they grow into that value? That's the question. Let's see what analysts think. Analysts, look at the growth rate they have. $8 per share growing to $13.77, which is well into double-digit growth rates from here on out. And revenue growth, double digits. 10, 11, 15% revenue growth rates from $1.9 billion to $3 billion per year. So, guys, what we do here on this channel is we're not just focused on a story. It's about merging the story and the numbers together. In the stock analyzer tool that's been used over 1 million times in the last year by our users in our software and community, that's the reason they use this. They take the story, they make assumptions on growth rate, profit margins, multiples based on the story, and it merges it together into the numbers. What's the right price to pay for the company? This thing has been used over 1 million times, like I said, and over 4,600 stocks have been analyzed in the last year alone. That's incredible. So the last time I did Paycom, let's see what numbers I came up with. So I did a 10-year analysis, and I did 6, 8, and 10% revenue growth. I'm going to change that slightly. Analysts are thinking better. I'll go a little bit higher, 6, 9, and 12%. Now, profit margin. I did 20, 23, and 26, and free cash flow to 18, 21, and 24. Now I look at this now going, okay, why did I do such a higher number? Well, I looked at the freaking gross margin of 88% and said this is going to be higher, but I think I should tailor that back just a little bit. Let's put 19, 21.5, and 24. And for free cash flow, let's go 16, 18, and 20. Now for my PE. Now the thing I like here is they have a high return on capital and they dominate this space. So I think it deserves a premium PE and price of free cash flow. I did 17, 20, and 23. And I did a 9% desired return. For those of you who are new here, 9 or 10% is the market average. So I'm trying to get my intrinsic value for the business, but never buy a company. I shouldn't say never, but you should try to buy a company with a much higher than market average return because you're buying an individual stock. Get that premium and it gives you that margin of safety. And you need margin of safety because the future's unknown and we're humans and we make mistakes. You got to have margin of safety in there. The stock's currently at 206. Hit the analyze button. I've got a low price of 107 on the discounted cash flow model, a high price of 264, a middle price of 170. On earnings, I have 130 to 316. And it's currently on my watch list at 150. And I'm comfortable with that still. I still feel like at 150 or below, I'm able to get a good company at a good price. And if it falls even further, I'm very comfortable buying more of it. Now, stock number 2 is going to blow your mind, guys. Tesla. Tesla's story feels straight out of a sci-fi movie, but it's happening in person right now, and this will be one for the ages. This isn't just about electric cars. Tesla wants to redefine how we move. Case in point, robo-taxis. Imagine a ride-hailing service with no drivers. Just like Waymo for Google, Tesla's vision is to leverage its full self-driving, the FSD tech, to create a fleet of autonomous income machines. With billions of real-world miles training its AI, Tesla's miles ahead in the race for autonomy. So their goal is that you buy a car, and then you can let it on the side while you're sleeping or while you're at work, go out there and do taxi service and make money for you. This would allow your Tesla to rake in up to $30,000 a year while you're working, sleeping, doing other things. That's passive income that could out-earn some day jobs. Now here's the kicker. Tesla's vertical integration is a massive advantage. Unlike Uber or Lyft, Tesla controls its supply chain. It builds its own batteries and designs cars for efficiency. Fewer moving parts, no driver costs, and Tesla's cost-cutting expertise could slash ride prices and boost profits. Even capturing a slice of the $150 billion ride-hailing market would be a huge transformation for the company. And of course, Elon isn't thinking small. He's hinted at a $1 trillion in potential revenue from robotaxis. For perspective, one car in this program could generate over $200,000 in its lifetime versus $40,000 for selling it outright. That's recurring revenue that's supercharged. Of course, there are hurdles. There's regulatory red tape, perfecting FSD, competition, but Tesla's head start and cult-like fan base mean they're playing chess while others are figuring out checkers. If this vision becomes reality, Tesla won't just be an automaker. It'll be a mobility empire. But I want you to remember, as of right now, Tesla's an automaker. Over 90% of its revenue comes from selling cars. Is there a piece of it that could become much bigger and become this? Absolutely. There's no denying that. But let's not forget that what it makes its money for today, you have to value the car business and the future potential of this other company. What's that future potential? Well, guys, it's not a shoo-in. Go look at Tesla's history. Yes, the stock has gone up, but people forget how often they miss their goals on things they set out to do. In fact, I believe 3 times Elon Musk said that Tesla was 2 weeks away from bankruptcy. Now, I think those days are gone. It is not close to bankruptcy anymore. They've done a great job of generating more and more cash flow. As you can tell right here, look at this. $3.6 billion last year, $4.12 in the last 5 years. That's what's interesting to me. This company is growing like crazy, and yet their free cash flow is down. Net income, $7.75 billion in the last 5 years, $12.7 last year. Big difference between free cash flow and net income, but to me, that's very easily explained away due to the fact that it's a capital-intensive business. They're building factories. They're building all these other things to sit there and make it a bigger company. Let's go check out the 8 pillars. And by the way, have you noticed the stock lately? Year to date, 75%. In the last 6 months, it's up 120%. In the last 3 months, 67%. In the last month, 30.7%. It has been on a tear lately. All-time highs being hit. Elon Musk at one point, I think, was worth $450 billion. To put it in perspective, all of the Walton heirs, I believe, are worth $450 billion combined, or $425. He's worth more or as much as all the heirs to the Walmart fortune. So let's go check out the 8 pillars, which I think are probably not going to look very great. And they're not. We got 4 X's, 4 checks. Revenue growth, huge. Net income growth, huge. Free cash flow, not as much. But again, go understand their capital improvements. Because remember, free cash flow is cash from operations less your capital expenditures. If you're spending a lot on capital expenditures, that doesn't hit the net income line for a while, but it hits your cash flow immediately. So there's issues there. 5-year free cash flow, 370. 5-year net income, 197. Again, people are pricing in this FSD, and that's always worrisome for me. I'm very surprised to see so many value investors talking about this company. I don't get it. It doesn't make sense to me in that regard. But let's go see what Stock Analyzer says. So let's pull up the last time we did Tesla, because I really want to understand the future profit potential. And maybe I'm not getting it, and you very well could be the case, and I'm okay with that. 10-year analysis. 7, 17, and 27% revenue growth. Big time revenue growth here, guys. Profit margin, I did 8, 14, and 22. Keep in mind, all of these numbers here, they've barely even hit the low number. The middle and high, they've never hit. So I'm giving it a lot of leeway here for more profit and for more free cash flow. PE, 18, 21, and 24. They're currently selling for 120 times earnings and 422 times price to free cash flow. And my 9% desired return, hit the analyze button. And before we go further, I'm going to do 2 stock analyzers here. I'm going to sit there and say, what's it going to take for their growth and profit margin to be in order for this to make sense? Because right now, it's hard. You have a low price of 50, high price of 800, middle price of 215. Okay. But again, this high price assumes amazing 27% revenue growth. Guys, let me show you what that means. 27% revenue growth for 10 years means they have 11 times growth rate in their revenue over the next 10 years. That would take them over $1.1 trillion 10 years from now. Is it possible? Sure. Is it probable? That's the question. And maybe you say, hey, Paul, for 16% return on that money, I'm fine with that. I'll take that risk. More power to you. That's the thing about value investing. We all use this principle-driven investing is about all using the same fundamentals, the same ideas, but you apply it based on your area of expertise. So let's sit here and make some different assumptions. Let's call it 10, 20, and 30% revenue growth. Let's call it 12, 18, and 24% profit margin. Let's call it 20, 25, and 30 for our multiples. Analyze button. We're still not there in the middle assumptions. We're still at 402. But hey, this high assumption is pretty huge. These are big numbers. And again, I want you to remember that investing is like making very, very calculated bets. The question isn't what's possible, it's what's probable. And do you see a mispricing in that? That is the question. Now, if you're new to this channel, I talk about this all the time. We talk about long-term investing, and a lot of people on YouTube sit there and look at short-term price fluctuations to determine if they're right or wrong. That is one of the foundations of our principle-driven investing. We do not look at that. Stocks can go up and down in the short run. You look at Tesla, up 120% this year. Are you really telling me that Tesla is 120% more valuable today than it was a year ago. The market says it was, but is intrinsically that the case? And you also heard me talk about the million times people use our stock analyzer tool in the last year in our community. Over 4,600 stocks were analyzed in the last year. So if you've looked at our website, you will notice as you go to sign up for our software that we have a waiting list. And the reason for that is, as of right now, our software includes all of these tools for retirement, stocks, and real estate. And I use these tools every single day. Even our real estate calculator, I bought over $30 million this year in real estate. And I'm about ready to buy another $45 million property using this tool. We use it all the time. I made this software for me. But what happened was people would ask for the software in the videos. And so we finally decided to give it to them. And as we built the software, we realized we had to make it more about you and less about me. So behind the scenes, we're making a lot of wonderful changes. We have full-time developers that work on the software every single day to make it better for you. It absolutely has to be more important for you guys than me as we grow. So that's why you need to go sign up now. Because when these changes happen, we're going to drastically either increase the price or take away a lot of these tools and sell them separately. So in order to get them all together right now, you got to go sign up now. Click on the link in the description below. It's $7 for 7 days. It locks you in and grandfathers you in for life. You will have these tools for life, no matter what we do with future packages if you sign up now. And more importantly, you also get locked into your pricing tier forever. So go sign up, $7 for 7 days. That's $1 per day. You will not find a better investment than that out there. So go start the year off right by investing in yourself. Stock number 3, Molson Coors, the 5th largest beer company in the world. And they're not just about brewing the classics like Coors, Miller, and Blue Moon. They've also got premium brands like Peroni, which my brother loves, and even a stake in non-alcoholic beverages. In short, this is a company with its fingers in a lot of beverage pies. But does that make it a good investment? That's what we have to see. First, revenue distribution matters. A whopping 80% of their sales come from the US, with obviously the remaining 20% worldwide. In 2019, Molson Coors got serious about its future with a revitalization plan. The strategy was simple. Go after higher margin products like craft beers, seltzers, and even energy drinks. Side note, their partnership with Dwayne Johnson to push in the energy drink market is absolutely brilliant. Say what you will about celebrity endorsements, but they work. And The Rock's marketing clout is undeniable. Now in 2023, which was an unusual year in beer history, the Bud Light boycott sent $150 million in Molson Coors' way. And here's the kicker. 80% of those customers stuck around. The question for us investors is this. How sustainable is their future growth? Are the craft beer and seltzer trends here to stay? Will they successfully carve out a niche in energy drinks? Beer probably isn't going away, but buying Molson Coors stock means you're betting on their ability to execute these growth strategies long-term. As always, price relative to value matters. If it's below our intrinsic value, I'd consider raising a glass to this opportunity. And guess what, guys? I drink 0 alcohol. And I always hear like on Shark Tank, the shark saying, oh, I don't do this. I'm not in this area, therefore I'm not going to invest in it. I think that's their cop out for saying, I just don't want to invest in you. Guys, I don't have to use something to understand its value and importance. Alcohol is here to stay. When I see family and friends get together, we make sure we have great beers for them, great wine, all these things available for them. So let's check out Molson Coors with their beautiful ticker symbol TAP. $12 billion market cap. A lot of debt here. $24 billion enterprise value. This difference is essentially their debt. So there seems to be a lot of debt in the company because they only generate $1.15 billion in free cash flow. The good news is much higher than their net income, which I like. Their current price to free cash flow is $10.5 billion. One thing I hate about this business, low returns on capital. So what this tells me, guys, is I got to have a lower multiple for this business. The question is it selling cheap enough? This is why it's on everybody's radar in the value investors community. 10 times free cash flow. I don't care what company it is. That's something interesting to look at. Let's see what the 8 pillars tell us about the company. Oi. Now here's what I don't like. Hey, mofos, why aren't you buying a ton of shares back? You're paying this 3% dividend, which is awesome for investors, but it eats up $367 million of your free cash flow, which is low. But guys, if you use that money every single year just to buy back shares, you're buying back 3% of the company every single year. That's what they should be doing, selling for 10 times free cash flow. Why are they wasting their money paying this dividend? Here's why. Because people out there want the dividend. And I get it. So a lot of debt here, like I said, 8.5 times its 5-year free cash flow. Quite a bit. Let's see what analysts are saying. Oh boy, not much growth here. 585 going to 670. It's not a grower or a shower, I guess. And revenue growth, not much. Okay, so they really got to hit it hard with these seltzers and these other expanded markets they're getting into. Guys, let's look at Stock Analyzer, but I think it's one of those companies with such a low return on capital and low growth rate. You've got to be very, very cautious in how you analyze this company. So guys, here's analysis for 10 years. I did 0, 2, and 4% revenue growth. That could be low. I get that. Profit margin, I did 7, 8, and 9. Free cash flow, as you can tell, is higher than profit margin. So I did 9, 10, 11. Might be a little low. I probably could have gone 10, 11, 12. Actually, I'm going to do that. I'm going to do 10, 11, and 12. 10, 11, 12. Now, PE, I did 12, 14, and 16. I'm actually going to go 10, 13, and 16. Guys, I don't like this low ROIC, and I don't like this low growth rate. I need this stock really cheap. And my 9% desired return, the stock's currently at 58. Hit the analyze button. All right. From a free cash flow perspective, this is why it's interesting, guys. I have a low price of 57, a high price of 115, a middle price of 82. Gives me a potential 14.5% return on your money. That's why value investors are liking it. Join the community, have a conversation about it, and watch our next video on stocks at 52 weeks lows. It's a great place to start looking for value. Thank you for your time.